Hey YouTube, Will Lopez, founder at advisorfi.com. Thanks for joining me here today. Today we're actually going to talk about the top 4 S-Corp tax deductions that all S-Corp owners have. Oh, how the founding fathers would be so proud in us. And how disappointed they would be with the Internal Revenue Service.
Ooh, you suck!
So before we get started, we're actually going to ask ourselves 2 questions here. The 2 questions we're going to ask ourselves are, how do we optimize our S-Corp venture through these tax deductions? So I'm assuming here that you're an LLC or you're an Inc. and you've completed Form 2553 and you've elected S-Corp status. So that makes you a shareholder employee of your S-Corp. So how do we optimize your S-Corp venture through these top 4 tax deductions? And the second question we're going to ask ourselves is, how do we do it right? Because the S-Corp rules and guidelines are very specific, and the IRS cares greatly about how you deduct certain expenses. And if you don't deduct them correctly, they can and will disallow them in the event of an audit. But before we get started here, if you'd like a 30-minute consultation with our team, be sure to click on the link below that's in the description, or you can go to a web browser and type in meetme.so/freebie for a 30-minute consultation. So let's dive right in. So tax classification. So I want to go over this basically first because I always want to ensure that people understand what I mean by S-Corp status. So if you've seen our other video about corporate structuring and tax classification, great. If you haven't seen it, be sure to click right now up top to watch that video first and then kind of come back to this video so that way it makes a little more sense for what you're doing. But for those who don't know, or don't even want to click on that video up at top. But you actually have, there are 4 basically tax classifications for business owners. And the first one is sole proprietorship. Generally this exists when you have an LLC and it's the default tax classification, or you're a not LLC and you're just kind of going around venturing, making money underneath your own Social Security number. The second tax classification we have is partnership tax classification. This too exists when you actually have an LLC and 2 or more people or businesses come together and they form a partnership together. It also exists when 2 or more people get together and they're doing business together, but they really don't have an LLC to protect them or provide limited liability. The third tax classification that's out there is called corporations. This is basically called C Corp structure, also known as the double tax corp. This exists when an LLC completes the C Corp IRS forms to elect C Corp status, or when an Inc. Actually starts and it's the default tax classification for an Inc. And the last tax classification, which is the one we're actually going to speak to here today, is the S Corporation tax classification. This is if an Inc. or an LLC has completed Form 2553 and they've received confirmation from the Internal Revenue Service that they are indeed an S Corporation. And under that premise, we're going to talk about the top 4 tax deductions for S Corporations. So my number 4 here, going all the way from number 4 down to number 1, which number 1 being the best, number 4 being obviously 4th from the best, would be the car mileage deduction. Now this is tried and true. This is the old faithful deduction as far as deductions are concerned, but there's a little caveat here when you actually have an S-Corp. Now for a lot of people, when they're sole proprietors, not S-Corps, this deduction seems pretty straightforward. They may go to their tax advisor or prepare their tax returns and they may claim how many business miles they drove that year. Generally, it's really straightforward. You can go to TurboTax, do your own tax return, or give a number to your tax preparer saying, hey, I drove 2,000 miles this year, and then he punches that number in and you get 56.5 cents per mile, and there's your deduction. Very, very different, though, under the S-Corp structure, but it's still very effective and very good, especially if you're driving around a lot for work. So in order to claim a deduction for business use of a car or a truck, a taxpayer, which is you, that is an S-Corp owner, must have ordinary and necessary costs related to one or more of the following. So in order for you to get this car mileage deduction, you obviously must be using your car for business reasons. And basically the reasons that the IRS lists are traveling from one location to another, visiting customers, taking trips for customer reasons. For example, we do taxes, so for whatever reason, if we have to go to the to the post office to drop off a tax return to be certified mail to the Internal Revenue Service, well, that trip to the post office and back is considered car mileage and would be the deduction for the business. Attending a business meeting away from a regular workplace, getting from and to a temporary workplace if you have one or more location that you're visiting. Now, the way you would deduct this under the S Corp status is instead of as a sole proprietorship disclosing how many miles you drove for business, according to the IRS, you must literally reimburse yourself cash. So what that basically means is you can, on a regular basis, and this is entirely up to you, whether it be monthly, quarterly, annually, however regular, you must keep log of the mileage that you use or that you drive for business reasons, and then on a regular basis, have your S corporation cut you a check, distribute money to you in some fashion of the mileage that you've driven during that period of time times the IRS allowed mileage rate. So for example, if here we're in 2017 at the moment, you drove 2,000 miles for your business and you have an S Corp, the way that your S Corp can get that deduction and the way that you can get that deduction as the owner of the S Corp is you must submit a mileage log to your S Corp and have your S Corp reimburse you for 2017 is 56.5 cents per mile, 56.5 cents per mile times 2,000 miles of cash reimbursements. And that's the way you're going to get your mileage, car mileage deduction through your S Corp. Very, very consistent, of old faithful deduction, but still very, very relevant for our day to day. And this one I would make number 4 as the top 4 tax deductions. Number 3, as far as the top 4 tax deductions that are out there, medical insurance. Now, this one's actually a little tricky as an S Corp, but very, very powerful. What I want to do is, unfortunately, I'm going to have to read the IRS code to you, and then what we're going to try to do is break it down here a little bit. But for all intensive purposes, a medical insurance plan. So if you have medical insurance, or actually let me take a step back, you actually have 2 options as an S Corp owner to provide yourself medical insurance. The first option is to have your S Corp have a group health insurance plan. That is, it's a health insurance plan that is literally sponsored by your business, and it's through the group health insurance network and provides it to you, Mr. or Mrs. Employee. The second way is if you have individual health insurance. That means you actually have it yourself. You went to healthcare.gov, you went to, Blue Cross Blue Shield, you have it, on yourself through the individual marketplace, but it's not underneath your business. You can get a deduction for that health insurance under your business if you do it a certain way. So what we're going to try to break down here today is how do we properly capture that medical insurance deduction through the group side. It's pretty straightforward because the business always pays the health insurance premium, but if you have it individually, that isn't as straightforward. And we're going to have to break that down and make sure how we do that. So according to the IRS, the insurance plan must be established or considered to be established under your business. So the IRS cares very much so as far as a medical insurance plan, especially when it's in your name. It's not in the name of your S Corp, being established underneath your business. So let's read the IRS code, which is also in the link in the description below that you can go to and get a little more information. And then what I'm going to do is break it down for you a little bit more. But according to the IRS, here's what they say. For more than a 2% shareholder, so let me stop there. That is, if you are a shareholder of your S Corp and you own 2% or more of the shareholder, this applies to you. A policy, that is a health insurance policy, can be either in the name of the S Corp, right? So like a group health insurance plan that the S Corp has, or in the name of the shareholder. So I'm Will Lopez, and I'm at advisorfi.com. That is, Will Lopez has individual health insurance from healthcare.gov, from Obamacare. So the IRS says, well, it can either be in the name of the S Corp or in the name of the shareholder. You can either pay the premiums yourself, or the S Corp can pay them and report the premium amounts on Form W-2 as wages to be included in your gross income. However, now we want to focus in here. However, if the policy is in your name, that is, it's not underneath the business name, it's you that have individual health insurance through the marketplace or through any of us directly with a provider. If the policy is in your name and you pay the premiums yourself, which for a lot of individual health insurance individuals that have that, that's generally the case, the S corporation must reimburse you and report the premium amounts on Form W-2 in Box 1 as wages to be included in your gross income. Otherwise, the health insurance plan will not be considered to be established underneath your business. So let's take a step back. What is this even talking about? Well, the IRS basically says this. If you have an individual health insurance and you want to get that deduction through your S Corp, which is very easy to do, very, very straightforward, the IRS says this. If you have that policy in your name and you pay the health insurance premiums out of your pocket, out of your personal bank account, the S corporation, your S corporation, must literally reimburse you cash of the equivalent amount. So if your monthly health insurance premium is $200, the S corp must give you $200, and at the same time, when it gives you the $200, report the $200 on your W-2 where you have your reasonable salary in Box 1 as wages to be included in your gross income. If you don't do it that way, according to the IRS, the health insurance plan will not be considered to be established underneath your S Corp. Therefore, you will not be able to get that deduction. So what are some pitfalls here? If you accidentally just have the S Corp pay your personal health insurance premium, and all you're doing is you're categorizing that transaction in your bookkeeping as health insurance, and you do not follow what the IRS has lined out to be, that is that the S Corp reports that amount on Form W-2 in Box 1 to be included in your wages. In the event of an audit, they will disallow that deduction, which means your taxable income goes up by that same amount, which means your taxes goes up as a percentage of that amount. So very important that you actually grab this deduction. And what I'm going to do here is I'm actually going to switch from my slide here to a Form W-2 so you can see what I'm talking about here on a Form W-2. But let's say, what does this basically mean? What this basically means is, let's say you have a W-2. What the IRS is saying is, if you have a W-2, and let's say you're paying yourself $30,000 a year, what the IRS is saying is this. You have a compensation of $30,000 a year, which is also subject to Social Security taxes, which is also subject to Medicare taxes. But if you want your health insurance as a deduction for your S Corp, then you must include that amount in Box 1 of your W-2. So let's just say, for easy math, your total 2017 annual health insurance premium that you pay for out of your own pocket is $6,000. The business must reimburse you $6,000, and then the business must change your Box 1 from $30,000 here in this example up to $36,000, and then at the same time disclose down here in Box 14 that there is $6,000 of self-employed health insurance to be disclosed to the Internal Revenue Service. So this is what the IRS is basically saying. So what happens is your health insurance isn't subject, so you get that deduction. It is subject to federal income tax, but it's, as you can see here, it's not subject to Social Security tax at all, and it's not subject to Medicare tax. Now, why is this a deduction? Well, if your business is paying you a W-2 and your W-2 goes up, what does that mean to your profits? It goes down. So if your profits go down, then your taxable income goes down, which means your taxes go down. So that's really what the IRS is getting around, and a lot of S corporations have a hard time making sure and ensuring that this particular tax deduction is done correctly. But the IRS is very, very clear that if you have an individual health insurance plan and it's in your name and you pay the premiums yourself, your S Corp must reimburse you the exact dollar amount, and it must put that amount on line 1 of your W-2 and disclose that same amount for the entire year on line 14 as self-employed health insurance plan. If you do not do it this way, your health insurance plan is not considered to be established underneath your business, and the IRS will disallow that deduction. But as you can see, fairly straightforward, so long as you're using good, payroll software, and try not to do this on your own, of course. At least that's my recommendation. At least you're really going to give yourself a hard time. But that's how we get that particular health insurance deduction for the medical deduction in an S corporation, and that would be the top third tax deduction that I would recommend. Top two, number 2 deduction of S corporations is something that's actually called Section 179. Now, this is an IRS section code that's actually being referenced, but that's basically what we call it, Section 179. And what this basically is giving business owners the ability to have advanced depreciation of equipment and property that they buy. So what do I mean? Let's say you buy a Mac computer. Let's say you buy the most recent Mac and you upgrade it all the way up, and it's about $5,000 investment. What Section 179 says is, or outside of Section 179, if you buy a $5,000 Mac for your business, according to the useful life in a tax code, you have to put that $5,000 computer as an asset of the business. And then every year, the IRS allows you to deduct a piece of the $5,000. So let's say that computer lasts 5 years. It's $5,000. Let's say the IRS only allows a $1,000 a year deduction. Okay? Pretty straightforward. What Section 179 says is you can actually advance or accelerate that $5,000 asset. Instead of doing $1,000 over the course of 5 years, you could probably do a big chunk like $2,500 in the first year, and then the rest of it over the next 5 years. Now, why this is so key is, as you can tell, you can front load the deduction in the current year or in the year that you bought the asset. And for a lot of us, that's really important because our profits may be really large, or we're trying to find ways to cause tax deduction. If you don't understand this concept, I would highly recommend you just speak to your tax accountant and say, hey, I bought XYZ assets. Do I have any opportunities whatsoever under Section 179? But according to Section 179, to qualify for that deduction, and many times you can actually fully write off an asset. So you can, in many instances, you can take that $5,000 MacBook Pro and deduct it all in 2017 under Section 179. There are some limitations to that. There's a link in the description below that expands a little bit more on the Section 179 deduction. Be sure to talk to your tax advisor about that. But according to the IRS, to qualify for the Section 179 deduction, your property must meet all of the following requirements. It must be eligible property. That is, it's not items or property that's not eligible for this particular deduction. It must be acquired for business use. So no, you can't take your new boat that you bought for you and your family and say, hey, I'm going to add this as an asset of the business and I'm going to Section 179 this thing. It must be acquired for business use. So if you buy a laptop for business use, if you go out and you have an office equipment, couches, chairs, TVs for your office, or t-shirts like you see here in the back, all those things are acquired for business use. That's obviously eligible property. It must have been acquired by purchase. So no, you can't go around in the streets finding things and saying, well, that thing looks like it's $500 of value. I'm going to Section 179 that thing I just found in the street for free. So obviously you must have acquired the asset or the property by purchase. And it must not be on the what property does not qualify list. So the IRS does have a what property does not qualify list. It's actually in the link in the description below that you can click on, and it'll expand a little bit about that. Also, I want to kind of expand a little bit more of what kind of property is eligible. and we're kind of not going to talk about what's not eligible, just what is eligible. So the material goods that generally qualify for the Section 179 deduction are just simple things like equipment, machines, computers, laptops, monitors, purchased for business use. Tangible personal property used for business use. Business vehicles with gross weights in excess of 6,000 pounds. So, if you're a box truck, box food truck, and, you bought obviously a huge food truck and you're going around and that's your business, obviously that could be subject to Section 179 so long as it is a business dedicated vehicle with a gross weight in excess of 6,000 pounds. Computers, computer off-the-shelf software. So this obviously clearly does not mean you coding software or you having customized coded software. These are literally pieces of software that you would go to Office Depot, Office Max, Staples, and you would probably pay $500, $1,000, $2,000 to literally buy the software to install on your computer. That particular acquisition is subject to Section 179, and you can actually advance the deduction of that in the same year that you bought it. Office furniture, office equipment, property that is not structural, that is a structural component of your office. What does that mean? Basically like a refrigerator. We have an advisorfi.com office. We have a refrigerator with a kitchen table where the refrigerator is not bolted into the wall. It's not built into the structure of the place that we're leasing or renting. So that particular office equipment or office furniture is considered property under Section 179. So things like, printing press, large tools, equipments, refrigerators, couches, things that are not a structural component of where your home office is or where you're renting or leasing your current office. So that's our number 2 tax deduction that we would recommend. And our number 1, which quite honestly I love because it really is a massive tax deduction and one that S-Corp owners rarely get themselves into because they don't know that they actually have this option, is the retirement plan deduction. So if you are an S-Corp, a shareholder employee, yes, you can involve into your business tax deducting retirement plan vehicles. And this is a wonderful opportunity to take those savings that you get through an S-Corp and turn those savings and start investing them into a retirement plan. We don't give investment advice. We're just saying according to the tax code and the Internal Revenue Service does allow for deductions for retirement plans of your S-Corporation. So according to the IRS, and we'll just read this so you can actually understand a little bit better, they call them one participant 401k plan. So the one that we actually see the most benefit as far as tax deductions are concerned, they're generally called solo 401ks, or sometimes they're called SE 401ks, SE standing for self-employed 401ks. There's a variety of names that people give them, but they're in essence according to the IRS, they're called the one participant 401k plan. That is, you own an S-Corp and it's just you. You actually and you can start a 401k plan for your business and take the savings that you would get in your S-Corp and reinvest them into this retirement plan. The IRS considers them a one participant 401k plan. And according to them, it isn't a new type of 401k plan. It's basically a traditional 401k plan covering a business owner with no employees or that person and his or her spouse. These plans have the same rules and requirements as any other 401k plan. So this isn't something new. It's just like a regular 401k plan that you would have at another company if you were an employee of that company and they offered a 401k plan. And so in essence, the business owner wears 2 hats in a 401k plan. He wears the hat as the employee who's contributing into the 401k plan, and then he wears the hat as the employer, where the employer actually has a non-elective or discretionary contribution that he can make into the 401k plan. Obviously, we don't do financial advising. We would highly recommend that you seek the consultation of a certified financial planner, a CFP, or someone at your local financial advising location near you. But basically, the owner can contribute one of 2 things into this 401k. So when you have an S-Corp, you have to pay yourself a salary, okay, a W-2. Well, just like when you get a W-2 from another job, what can you do if you participate at another job's 401k plan? You can say, hey, I want $5,000 of my W-2 to go into a 401k. And so the company withholds $5,000 and puts it in on your behalf. So when you have your own S corporation, you can do the same thing. You can say, I want to establish a 401k plan as a retirement plan vehicle of my S corp, and as a shareholder employee, as the employee, I want to contribute a percentage of my W-2 into the 401k. So you can do, as the first point alludes here to, is you can do elective deferrals up to 100% of your W-2, not to exceed the annual limits the IRS has provided from the W-2. So for 2017, the most any employee can contribute into a 401k that is sponsored by their company is $18,000. So you have the option as an employee to contribute up to $18,000 during 2017 into a 401k. But here's where it gets better. And this is where it's different with an S corporation that you own and not as an employee of just another company. The second option that you actually have here to advance or accentuate the tax deduction is the company itself can provide what they call a non-elective or a discretionary contribution into the 401k plan on your behalf. So you as the employee can contribute up to $18,000, which is the IRS requirement from your W-2. And the company, the S corp company that you own, can also put in money into the 401k plan on your behalf. Now, it's limited by 25% of your W-2. So if your W-2 were $100,000, you could put in up to $18,000 of your $100,000 into the 401k plan, and the company can contribute $25,000, which is 25% of $100,000, into that 401k plan on your behalf. So that is obviously, $43,000 that you can contribute into the 401k plan, and all of it tax deductible for yourself and for the business. This is why this is the #1 tax deduction recommendation that we would give. And anyone can set up a 401k plan, a solo 401k plan. It's very cost effective to do so, so long as you follow the guidelines through the Internal Revenue Service, and you also follow the guidelines through your payroll provider to make sure that you are deducting your 401k contributions properly through your payroll provider, and that you're also disclosing on the W-2 that the company's making a non-elective or a discretionary contribution to the 401k plan that you have. Let me share my screen one last time so I can show you what this looks like. We actually have no affiliation whatsoever with Fidelity, but they actually have a very neat and cool calculator that I like to kind of explain this concept. But let's say you have a solo 401k for your S corp and it's just you. They have basically a 5-question simple questionnaire. It just says, do you have a business plan with us? I'm just going to say no. Let's say it's for this year, 2017. Let's say the type of business is it says corporation here, but assume it says S corporation. And then it says, what are your wages? Well, let's say in that same example that I gave you earlier, it's $100,000. That's your W-2. Let's just default the age to 30. And what Fidelity is going to do is it's going to calculate that you basically have 2 options for your S corporation to get a deduction. The first option is a SEP IRA, which I am not speaking about, but the second option is the one I'm referring to, SE, once again standing for Self-Employed 401k. Your total annual contribution into a solo 401k is $43,000. In the same example I gave to you earlier, that is $18,000 through your W-2, and then the company can contribute 25% of your W-2, which is another $25,000. So $18,000 plus $25,000 that the company contributes in addition to what you did as an employee is your total tax deduction, and it's literally reduces your company's net income, which reduces your personal taxable income, and therefore reduces your personal tax obligation federally and state at your marginal brackets in the federal government or state. So those are our top 4 recommendations for tax deductions for an S-Corp. As far as payroll is concerned, ensuring that these deductions are being taken properly and included on your W-2. Our software recommendation of choice as far as payroll is concerned is a software called Gusto. You can actually click in the link below, in the description below, or we actually have the web link showing right here on the video. But Gusto can ensure that your health insurance deductions are properly taken on your Form W-2 and included in Box 1 and that amount shown on Box 14 of your W-2. Gusto can also ensure that you are reimbursed your mileage deduction through your W-2 at no tax ramification to you, but also as a deduction for the business. You wouldn't use Gusto for your Section 179, which is the second tax deduction that we would recommend. That you should speak to your tax professional for. And the last deduction, which is the retirement plan deduction, yes, you would use a platform like Gusto to ensure that the elective contributions, that is you as the employee and running a reasonable compensation for your S-Corp, the deductions are properly taken through your W-2, through Gusto, and that the company has made a discretionary, non-elective contribution also into your solo 401k, which Gusto can help you ensure that that also shows on your Form W-2. All right, guys. Well, if you have any questions, be sure to click on the link below if you wish to schedule a free 30-minute consultation with us, or you can go to a web browser and type in meetme.so/freebie for a free 30-minute consultation. Thank you guys for watching this video. Hopefully we'll see you guys on the next one. Take care. Hey, thanks for watching. Hopefully we were able to answer all your questions. Be sure to click on the subscribe button down below to follow us for future video releases. Check out this video up here for our best recommended video for you. And right underneath it, check out our playlist, which is our best recommended playlist. See you guys on the next video.